Right now by David K. Johnson. He is the author of most recently The Fine Print and a Pulitzer Prize winner. You've covered the tax issues in prior books. It appears that what Microsoft did was perfectly legal, and that was in one of the names of your other books. Right. So in The Fine Print, you detail a lot of these things that corporations have done that they're allowed to do, and it's helping them, as you say in the subtitle, use, quote, plain English to rob you blind. Right. First of all, what do you think about this Microsoft story that's
well, the scandal is the law here. Congress, since 1909, has had a law that says companies can't hold on to more cash than they need to reasonably run their business. And there's even a mechanical test of how much cash you need to run your business. If you hold more cash than that and don't pay it out as a dividend or invest it in the business, there's a 15% penalty tax. But Ronald Reagan signed a law that nobody wrote about at the time, back in the 80s, that said as long as you hold the cash offshore and it's untaxed, you can have unlimited amounts of cash. So you may recall a couple of months ago, the Fed announced that American businesses had $1.7 trillion in cash.
Yep.
That's here in America. They actually have, I calculate, about $6 trillion of cash, almost 4 times that much. And in this case, what's happening is if you have untaxed cash offshore, you can't directly borrow against it. You can't go to the bank and say, give us a loan for $6 billion. We have $6 billion in a bank account in Switzerland. But if you've got $30 billion and you need 6, you go to a bank and say, we want to borrow $6 billion. We got lots of assets. We're just not going to specifically use that as collateral, and you can borrow the money. And that's what Microsoft did. They borrowed against their foreign money here as a way to avoid taxes. Very wealthy people do the same thing. If you're a multi-billionaire,
which I'm not.
Right. Unfortunately, you're not a multi-billionaire, and your company doesn't pay a dividend. How can you have these mansions and jumbo jets and everything? Well, you borrow against that money. And the borrowing rates right now are 2%. The cheapest tax you would pay is 15%. You're way ahead, and you never pay taxes, and the rest of us have to pick up the burden by paying higher taxes or getting less government services or the government taking on more debt.
Right, and I think that's one of the big themes of your book is that corporations are getting all these breaks, that they're writing the laws in some cases directly.
Multinational corporations.
Multinationals, and the rest of us are paying the price.
Right.
There's one example you give, I believe it's 6 states have given tax breaks to companies to encourage them to keep jobs within those states, and the companies get to keep the income taxes for those states that the employees are paying?
It's actually 19 states.
19 states.
2,700 companies. Every big brand name company just about you've ever heard of, they get to pocket the state income taxes withheld from their workers' paychecks. The workers don't know this because they're treated as having paid it. The companies get a tax credit equal to it. And let's assume at the end of the year you under withheld. So you owe the state $500. So you write a check, state government tax agency $500. That money doesn't go to the pay for school teachers and judges and cops. It goes to pay for the company.
Does that money get redirected to the company?
The company gets a tax credit equal to whatever the obligation is of its workers. So General Electric, for example, put $126 million into fixing up one of its factories in Ohio. $115 million of that came from their workers through the taxes they got to keep. That means they only spent 8 cents on the dollar. So if they make an 8% profit on the sales of that factory, of their investment, they then are making 100% annual profit. This is not market capitalism. This is not competition, which I champion in my books. This is what I call corporate socialism.
Right. So how do I know if my employer, and I hope to God Yahoo isn't doing this, is doing this?
Well, there is a website where a little tiny group spent several years building it called Good Jobs First. goodjobsfirst.org, and they have a database of these 2,700 plus companies, and they keep adding them.
I heard on the radio this morning, I don't have the numbers in front of me, a Gallup poll showing that the majority of Americans think that U.S. corporations, there's too much regulation. They're over-regulated. And you're laughing, but I wanted to get your response to that, because you basically, your whole book is about how the opposite is totally true.
Well, I teach the history of business regulation in the law school and the graduate business school at Syracuse. Most of the regulations are sought by business. Most of the regulations exist to thwart competition, artificially raise prices, reduce people's ability to get redress from a company. It's corporations that ask for these regulations. They write the regulations. And so we have this incredible myth, and I'm not surprised that a poll shows this, but it's not true that we're heavily regulated, especially compared to how companies are regulated in Europe and Canada.
Can you put a number or what the impact has been on our society?
Well, the average family, I figure, just for a handful of the items I read about, spends $2,400 a year. The average family of 4 in America now spends $900 a year. That's more than a week's take-home pay for the average family with 2 children in state and local government subsidies to corporations. And the one thing I do in this book I didn't do in the previous two, in the fine print there are solutions, lots of solutions, how we can fix this. And the fundamental story of the book at the end is reform begins with you.
Okay, and the price of just about everything has come down in the last 10, 15 years, from cars to food to clothes to electronics. About the only thing that hasn't come down in price is the internet itself. I'm joined now by David K. Johnston. He's a Pulitzer Prize winning reporter and the author of most recently The Fine Print, in which you detail, among many other things, how a lot of money has been allegedly sent to the telco companies to build out the information superhighway, and yet America, we're ranked number 29th in internet service, and we're paying more on average than the rest of the world. What went wrong here?
Well, in the fine print, the telcos got the rules changed while we weren't watching. So only 16 million people will have fiber optic service from Verizon. AT&T service isn't really fiber optic, it's cable or a copper wire at the end. While our competitors, recognizing that the internet is to the 21st century digital economy what canals and railroads were to the 19th century economy, they're investing in it, and we're not. And so we end up with huge areas of the country, including where I live in western New York, near Rochester, that are never scheduled to get super fast
They're never
service.
scheduled to get it.
Never scheduled to get it at all. And costs have gone through the roof. I get a triple play package. I pay with taxes $160 a month for the basic package, which is very common around the U.S.
Yep.
In France, a triple play package is $38 U.S., and you get an internet that is 10 times faster downloading, 20 times faster uploading. You get worldwide calling to 70 countries for no additional cost instead of just 2, the U.S. and Canada, and you get TV from all around the world. And
so they're paying 4 times less for 10 times the quality?
We're paying 4 times as much for less, and when you adjust for quality, we're paying 8 to 10 times what the French are paying. On a per digit basis, we're paying 38 times what the Japanese pay, and we rank behind countries like Ukraine, Moldavia, Norway, Lithuania, in the speed of our internet. This is terrible for commerce and for our economic future.
Right. So you write about and you detail how the telephone companies collected about $360 billion in fees from all of us as users. That was intended to go towards building out.
And the cable companies got well more than $100 million on top of that. So we're talking about $500 billion.
$500 billion. Where did that money go is one question, but the other, you're saying this is an economic issue. It's not just that we were all essentially fleeced by these corporations.
Well, I think a lot of that money ended up going into building the cellular systems. That's what they built during that period of time.
Right.
And it would require a massive investigation to prove that, but I think that's what we would find if we had one. But the fundamental problems were that the description of how fast the internet would be that was put into the regulations was very slow. In a lot of places it's 45 megabits, whereas in Chattanooga they built a municipal system, 1 gigabyte. In Lafayette, Louisiana, they built huge local municipal system, where they also, by the way, built municipal electric system 100 years ago. And as a result, a lot of the Pixar animation work from California is actually done in Lafayette, Louisiana. But in the high-tech city I live in, Rochester, home to Kodak and a whole lot of other companies where the Xerox machine was invented, can't do that because we don't have it.
Right, and so unlike the French and the Japanese and the South Koreans, the government hasn't spent the money to do the build-out. Is that what you're saying should have happened, or you're saying the money was allocated for it and it just wasn't spent?
Well, I'm not so much in favor of the government building it. I like market competition. But the rules should have said you have to build this everywhere. And in fact, the industry told us they were going to do that in the 90s. You remember there was an ad on Quest. Shows a grizzled old guy walks into this motel in the middle of nowhere and drops his satchel and says to the young woman behind the desk, "Got rooms? King-size beds. Room service? Coffee and donuts in the lobby. Entertainment? Every movie in every language ever made
on
in
demand,
every room.
in real time." Right.
Yeah, and we didn't get it. We paid for it and we didn't get it, and it's going to damage our economy. It's going to hold back our economy. People should be complaining to their state legislators, to their congressmen, and saying, "Where's my high-speed internet?"
Right, because what we call high-speed internet in this country, they would laugh at in almost any other part of the developed world.
I was in Korea this year, and people literally laughed at how bad the American internet was when I interviewed people.
Right, so I was there a few years ago, and I was astounded. I could watch live TV in the subway, and everybody else was, oh, of course, you can't do this in America.
Right.
And if we get a cell signal around here, it's like, wow, this is really great. So we're so far behind. Why do you think that the industry has become a cartel, a monopoly? I mean, because it does seem like if you say you move to a new town,
right,
you might have a couple of options, the telco company or the cable company, but essentially the services are very similar and the prices are very similar.
Well,
where's the competition?
In fact, Verizon and Comcast now have a cross-marketing deal in certain areas. In some places, the local telco and the cable company have gotten state utility commission orders that allow them to avoid competing directly with one another. And I believe, yes, we're seeing the emerging cartel of AT&T and Verizon, Comcast, Cox, Time Warner, CenturyLink, and a cartel is not good for economic growth. It's good for the investors in those companies, but it's not good for economic growth. And these companies essentially have a business model now that is antithetical to economic growth. Their profits go up if they can provide a slow internet at super high prices. If they provide the kind of internet our economic competitors have, their profits will probably go down, and they'll have to spend a lot more money on capital improvements.
It's been just over a week since Ben Bernanke launched Quantitative Easing Part 3, or what some are calling QE Infinity. I'm joined now by Axel Merck. He is president of Merck Investments and manager of the Merck Funds, and a hard money kind of guy. Axel, you've been very critical in the past of what Ben Bernanke has done. What was your take on his announcement last week that basically the Fed is going to continue to buy securities for as long and as far as the eye can see?
Well, that Thursday morning before the announcement, we tweeted what the FOMC statement is going to say, which means don't worry, be happy. We'll make sure you'll be fine. There are two key things about it. One is that it's open-ended, so the market can't just price in the ending of it. But more importantly, he is breaking the link between monetary policy and inflation. He's tying monetary policy to the unemployment rate, which means that anything he can to push up growth, which means he's going to disregard inflation, and as a result, of course, the dollar plunged and inflation expectations went up. And so if you think about it, inflation expectations go up, which means where is that low interest rate environment that he wants? Now, sure, mortgage rate has come down a little bit,
right,
but the real impact that QE3 has is in the weaker dollar. He hopes that he can boost exports with that. And he has signaled as much. I mean, if you read his 2002 helicopter speech, and that's required reading for everybody once a month, he says in there, well, weakening the dollar can help you get out of a deflationary environment. He signals what he is going to do, in this case, 10 years ahead of time.
Right, and you wrote a piece about this titled, "Is the Fed's Goal to Debase the U.S. Dollar?" It's obviously a hot-button issue with our viewers here in America generally. I mean, do you really think the dollar is going to lose its reserve status, or something else that dramatic is going to come out of this?
The dollar is a reserve currency for liquidity purposes, not because of the great value. If you have $1 trillion to deploy, there is no game in town. It's the advantage of having so much debt. The Italian and the Japanese debt markets are also reasonably liquid, but the U.S. is the one game in town. Everything is surrounding what Bernanke is thinking. He's very consistent. He has said going off the gold standard or further away from the gold standard during the Great Depression has helped the U.S. recover faster from the Great Depression than other countries. Now, mind you, fiscal issues were the problem in those days just as they are now,
right,
but still, that's his mindset. Monetary policy is one of the tools. Obviously, everybody else also wants to get a weaker currency, but we have the better printing press in the U.S. than in other countries. The reason they have these problems in the Eurozone is because they're on the other side of the Bernanke trade. Stronger currency, but a boatload of problems. We feel very happy because we have the printing press.
Right, yeah, certainly, the financial markets have felt very happy since this announcement. The Dow and the S&P hitting multi-year highs. Gold had a big move, as you would expect. And I think it's notable because so many people expected him to make such an announcement, and it still had a positive effect for the financial markets.
It had the positive effect because he officially cut that link to inflation.
Right.
That is a huge step forward. Everything else is kind of cosmetics around it, but he is signaling to market, and we'll see more of that. It depends very much what becomes the next administration. If we get an Obama administration again, well, we'll have either Bernanke or Roma, who's from Berkeley, or Yellen, and they'll be even more explicit with an employment target. If you think about it, we need to raise the price level in order to bail out the folks who have too much debt. and to raise the price level of housing. Housing is the core focus of Bernanke. It's not the fiscal cliff. He lists that far down in his list of priorities, even though that should be the main driver, because it's really the fiscal side that's the problem. But Bernanke is just focusing on the monetary side.
Well, to that point, you mentioned it earlier. His view of what happened in the Depression, and there are fiscal problems, and there's certainly fiscal problems now. If you're sitting in Ben Bernanke's chair today and you see the fiscal cliff is coming, the economy is already weak, wouldn't it be the right thing to act very aggressively as Fed chairman?
No, it would be the right thing to tell Congress to get their act together.
He's done that. He does that.
No, he doesn't do that. He just provides lip service like every other Fed president does. What he should do is say, look at the Soviet Union, look at Cuba, look at North Korea. Would monetary policy have fixed the mess that they're in? No, it does require Congress to get rid of the uncertainty on the tax side, on the regulatory side. They need to be the ones getting their act together. And he should just put his foot down. Instead, he's printing all this money, and this money going to flow somewhere. It's going to mostly flow out of the dollar and create havoc in other places in the world.
Right. So do you have any sympathy, though, for this idea that he's the only quote-unquote adult in the room, and he feels like he's got to do something because Congress is doing nothing?
Well, it is, yes, he's an adult in the room, but it is human nature to try to debase one's currency. When you have a printing press, you're tempted to use it. That's why some folks say you need to go more to a rule-based approach or to some other based approach. In a democracy, inflation is the path of least resistance. And by the way, we have problems everywhere in the world. We just have too much debt in the world. And we're not going to come to major entitlement reform and get a sustainable budget unless the bond market forces us to do that. Look how it works in Europe. Not well, but at least they're engaging in some structural reform. And we just don't do that. We'll do it once we get that. But keep in mind, we have a current account deficit, so we are far more vulnerable if and when our bond market starts to misbehave.
All right, we do have to wrap. Just quick thought, like, how do you see this all playing out? I mean, there's all kinds of Again, highlighted growth in the manufacturing sector as one area where there's been some success on the employment front. If my next guess is right, it's going to continue to get better and potentially a lot better between now and 2020. Hal Sirkin is a senior partner at the Boston Consulting Group, which just raised its projection for manufacturing jobs in the United States between now and 2020 to 5 million from 2 to 3 million in their prior projections. Hal, what is behind this projection of more manufacturing jobs here in America?
Well, Aaron, the big change is that we've taken a good look at exports from around the world, and the U.S. will be able to capture a significant amount of export share from some of the countries like from Europe and from Japan, as well as European and Japanese manufacturers, because of the low-cost manufacturing in the United States, will start to move production to the United States.
Right. So I could envision manufacturing here being competitive versus Europe and Japan. You're also saying we're going to have more manufacturers decide it's cheaper or at least cost competitive to manufacture here versus in China. Make that case for me.
Well, it's very simple. As the differential cost between the U.S. and China starts to get below 10%, manufacturers start to recognize that it doesn't make a lot of sense to deal with all the hassles of producing in China. It's 7,000 miles away from New York. It has, therefore, long supply chains that make it very inflexible. And, of course, there's a real premium to manufacturing in the United States versus manufacturing China in terms of the brand.
Right. So you say that right now the average manufacturing cost in China is only, and I'll put that in air quotes, 10% lower than it is here in the United States. I think most people would think that just because of labor costs alone, it's a lot cheaper than that.
Well, labor costs, of course, are a lot lower in China, but the U.S. worker is 3.2 times as productive as the Chinese worker, and that makes up a lot of the difference.
Right. How much of a factor is that, or is that a factor in these projections you're making?
Well, it is a factor. The dollar is clearly weaker than it had been, and that's part of what creates the manufacturing renaissance.
Right. And what about, a lot of talk about that on the campaign trail as well. It doesn't seem like it's been an impediment for these multinationals bringing jobs here. How much, if at all, is that a factor in these projections?
Well, companies think about corporate taxes as part of the equation. Obviously, wages and labor rates are very important as well. And what they're doing is they're balancing it. But what we're seeing is U.S. companies expanding manufacturing. We're seeing German, French, and Japanese companies coming to the U.S. to manufacture. And we're even seeing Chinese companies looking at the U.S. manufacturing position because for some of the goods they make, the shipping costs are getting quite high.
Right. So again, your projection is up to 5 million jobs in manufacturing between now and 2020. which is up from your prior projection. Is that a net total jobs, or there's still going to be jobs that are going to be sent overseas, correct? Manufacturing jobs?
Yeah. Yeah, what we're seeing is a switch. We had been doing a lot of outsourcing for the last 10 years since China entered the WTO in about 2001. And now what we're starting to see is them coming back. Whether you call it reshoring or insourcing, it doesn't really matter, but they're coming back in different ways. They're coming back to the U.S. because U.S. companies used to do that. They sent it to China and they're bringing it back. They're coming back to the U.S. because European companies are looking at it and saying, it's just much cheaper to make it in the United States.
Right, and again, I can understand the cost differential between the U.S. versus Japan and Europe, which are pretty developed, high-cost centers. What about other places in Asia, Vietnam, Indonesia, other places like that? Don't they provide competition for the next generation of manufacturing?
They certainly do, and we don't expect that all the jobs will come back. A small proportion of them. But you look at countries like Vietnam and Indonesia and the Philippines, and companies who have been in China think, well, those are probably pretty good places to go because the wages are a lot lower. When they visit a lot of those countries, they realize that they don't have the infrastructure, they don't have the skilled workforce, they don't have other important issues like good port capacity, and of course they face in many of those countries a significant amount of corruption. And they begin to think, should I make my next factory decision? Some will put them in Vietnam, some will put them in Indonesia, some will put them in the Philippines, and some will put them in Mexico, but a bunch will also go to the United States.
Week, Fed Chairman Ben Bernanke said, and I quote, "This initiative should provide further support for the housing sector by encouraging home purchases and refinancing," end quote. I'm joined now by Kermit Baker. He's Senior Research Fellow at Harvard's Joint Center for Housing Studies. And Kermit, obviously the Fed is doing everything they can, but there's also some data out this morning showing that in 2011, mortgage lending was at a 16-year low despite zero interest rates and at the time record low mortgage rates. So first of all, will more quantitative easing do anything to help the housing market?
Well, I think it's going to help a little, but certainly not a lot. Mortgage rates are really not the issue now in terms of home buyers getting back into the market. They're at record lows, and it's really the underwriting standards, appraisals, and things like that are really holding back the market, certainly much more than mortgage rates.
Right, so let's talk about lending standards have certainly gotten tougher than they were during the boom, which is a good thing. Has the pendulum swung too far? Are banks too tough now in their willingness to lend?
Well, I think they are. It's hard to take that position too forcefully, I guess, given what's been going on in the housing market over the last 5 or 6 years. But someone who's gone through a refinancing recently, they certainly demand a lot of documentation and seem to be setting the standards really, really quite high. We've seen FICO scores go up. So clearly they're eliminating the lower tier of potential borrowers, enforcing the down payment rules and things like that. So, you need to move in that direction, but I think they probably have moved a little bit too far.
Right. So I gather you're fairly optimistic about the state of the housing market generally, and we'll talk more about that in another segment. But the bears out there will say like everybody who can get a refinancing has already done it, and so maybe we've reached the end of this bit of recovery we've seen in the housing market. Is there anything the Fed or other bank regulators can do or should do to get banks to loosen the purse strings a little bit more?
Well, the Fed, in terms of setting interest rates, I think has, as you suggested, into the line. I think certainly there could be a little more pressure on banks to make good, solid, qualified loans. A lot of banks are just ignoring the housing market these days, avoiding real estate investments. I think they've been burned so badly that they decide that they want to put their money in other directions, and it's difficult for others to step in that see opportunities here. So it's a tough transition back to normal in this market.
Right, but would the Fed now targeting mortgage-backed securities, is that going to potentially help? I mean, you can make an argument that perhaps the Wall Street firms will say, well, there's more demand now for that product, mortgage-backed security, by doing more lending, more activity.
Well, we'll see. I mean, that hasn't worked so far. I think there's strong demand out there. We see the inventory of homes on the market near record lows. I think there's a lot of evidence that the demand is there, and banks haven't stepped in yet. I'm not sure lowering long-term rates, another quarter point, half a point, or whatever, is going to make a significant difference in that front. The demand is there. Banks are nervous to get back in this market, and I'm not sure rates are going to change that dramatically.
Right, and just to step back and talk about politics for a second, we're about 50 days from the election. Housing, obviously a huge economic issue, and it doesn't seem like there's a lot of discussion about this. But are you surprised this hasn't been more of a focus for either Mitt Romney or President Obama?
Well, I am surprised because the economy is the number one issue, and I think most economists would say that housing is the number one problem in getting the economy moving again. We've never had a strong economic recovery without housing participating in that, and we're just beginning to see that now. So, not any easy solutions, I think, but I am surprised that there hasn't been more focus on this as a lever to get the economy moving again.
Right, and generally speaking, or as someone who works at a university, what kind of grade would you give the president on his handling of the housing market? They've obviously tried as far. None of them have been as successful, certainly, as the White House would have liked.
I think that's right, and there's a lot of fundamental problems in terms of house prices being too high, in terms of consumers being over-leveraged, in terms of homeowners borrowing too much, and there clearly wasn't any quick fix for that. I think that sort of has to run its course. I think the administration was probably a little bit late coming to the game in terms of allowing underwater homeowners to refinance. So on the margin, maybe should have been a bit more aggressive, but overall I think there was really a limit as to what they could do.
Right, so is that a gentleman's B-, it sounds like, for a grade?
Oh, no. Not at all. I would say, I would say a solid B in that regard.
A solid B. Okay, we got to leave it there, Kirby. Thanks very much.